Thank you for taking the time to view today's webinar on the transitioning insurance market. And this is presented by myself, Jonathan McCardle, and I am a development leader at Marsh Commercial. We specialise in insurance, risk management and employee health and benefits policies. So the agenda for our presentation will seek to provide some background to the transitioning market, the factors that are influencing specific class lines and the measures that you can take to manage your insurance renewals in 2020 and beyond. The insurance market is entering a period of trading transition. The comments on this slide are some examples of the type of questions that we are receiving in the face of real life scenarios. So what is changing now? What developments might you, as insurance buyers, expect to encounter? And what steps can we take within Marsh Commercial to support you when entering into the renewal cycle so as to be better prepared for outcomes? Now, it is probably first best to reflect on what a transitioning market is, and more importantly, how this will differ from the trading environment that we've become used to in the UK insurance market for over 15 years. Indeed, across the industry itself, there are many insurance professionals who have never experienced anything different. So for the past 15 years, the UK insurance market has been what we call soft. Fundamentally, this has meant that insurers have been focused on growth. This has been underpinned by no shortage of capacity, born out of abundant investment capital, buoyed by the potential of attractive and stable returns of insurer profit following the financial crash of the late noughties. This has been evidenced in trading outcomes in the example shown on the screen. In summary, there is wider cover, cheaper premiums, and competitive quotes from various sources when we are operating in a soft market. So what's different now? What's different in 2020? Well, there are various factors, including legislation and Brexit, but fundamentally, the underlying driver is claims and the impact that this will have on actual and the future anticipated returns for insurers. Our current statistics that we've developed at Marsh Commercial are showing particular areas where there have been stark increases in both the frequency and severity of losses. There are further examples where insurer analysts have just got it wrong. They've modelled it wrong and they've got the investment returns wrong. So this has driven consolidation and strategic reviews to manage costs. For some insurers, there is nowhere to go. So that has seen an unprecedented withdrawal of UK capacity for many years, including the all-important reinsurance market, which underpins various capacity streams. For those who don't understand or have heard of reinsurance, reinsurance occurs when multiple insurance companies share risk by purchasing insurance policies from other insurers to limit their own total loss in case of a disaster. The whole idea behind that is that no insurance company has too much exposure to a particularly large event or disaster. So when your insurance policy is purchased, your insurer then purchases an insurance policy on top of that to mitigate their risks. Now, as insurers respond to deteriorating results and the reduction in readily available equitable reinsurance, we will see a return to a focus on technical underwriting and risk management to drive profitability. The insurers will trend their claims data and take conservative remedial actions across trades and class lines in respect of the rates, terms and capacity that they apply. Where data is insufficient or returns are undesirable, we will see an averse and selective approach to risk acceptance. So on this slide are the trading challenges that we are already encountering. We should also reflect that these slides were prepared prior to us understanding the full implications of the UK flood claims between 2019 and the current time in 2020, and the ongoing and developing coronavirus outbreak. So what are the drivers within our main insurance class lines, and what are the challenges and trends? Well, the drivers affecting UK property include claims, because these are increasing in severity and frequency, insurer consolidation, there's less competition between insurers if we don't have enough insurers in the market. Risk management disciplines, there is ever increasing focus with some insurers now insistent on survey submissions for new business. Climate change, which is currently being felt particularly hard in the UK. Modern building methods, I think to Grenfell for the issues with cladding. A just-in-time culture, which can have severe implications for business interruption claims when a loss occurs. Now, there are various types of property risk that are now becoming increasingly challenging, and we've listed some examples on this slide. In particular, with regard to modern methods of construction, there are too many examples of fires that have developed more severely and quickly than either building specifications or insurer own estimated maximum loss projections have estimated. Insurers' expectations on risk management standards are becoming far more robust on heavier trades, and the provision of quality risk control information and progress updates on risk improvements is now a prerequisite. And the drivers affecting UK liability include the Ogden rate. So the final revised level was still above the market's anticipated figure. This was coupled with increased life expectancy. We continue to drive claims inflation because of this. Litigation costs continue to drive defence costs, even for speculative claims. Within a more litigious society, the ongoing development of claims management companies support a growth in claims frequency. Now, the liability market appetite is surprisingly less challenging than other classes, other than difficult trades. Lower attachment excess of loss placements are becoming more price sensitive. Particular attention should be paid to analysis and understanding remedial actions where there is claims frequency or claim severity. Provision of detailed breakdowns of wage, roll and turnover can really assist with targeting optimum premiums for you. And in addition, we can expect that insurers will require further supplementary risk assessment information to support underwriting and defensibility. Now, the drivers in the motor market include the already mentioned Ogden rate, life expectancy and claims inflation, the new terrorism levy in the aftermath of tragic motor-related incidents, and whilst telematics and the portal are helping to manage injury claims, the development of ever more complex vehicle designs are increasing the average cost of damage claims. Think back 10 years, if you would have had a bump in the back of your vehicle, it would have been off to the scrapyard, pick up a new bumper, it would have been fitted and repainted for a couple of £100. And away you go. A really easy fix. Probably you wouldn't even have claimed on the insurance for it. If you've got a Tesla or any other vehicle that's got smart reversing cameras in or sensors in, that bumper's actually now worth a lot more money than a couple of £100 in a quick spray paint with all the new metallic paints which are in the market. So even simple repairs from 10 years ago are now adding up into the thousands where they would have been in the hundreds. The drivers affecting the UK financial line market include changing litigation and regulatory landscape. Actions have been brought outside the US at a greater frequency than anticipated. Losses are coming through on claims, including on D&O, following on from the financial crash. And insurer performance. The directors and officers insurance market combined operating ratio figures have been through various adjustments. And what we can see from this is that insurer analysts simply got it wrong. They priced it too cheaply. They didn't see that the claims were going to be so severe. And now they're sitting looking at that and having to adjust their premiums. For directors and officer risks, there are no trades or territory that hasn't generated claims that are trending above forecast, and caution across the sector is recommended, especially where higher limits are sought. Now, this slide is a really good summary of the numerous points that we've explored. It provides an illustration of the range of corrective actions that underwriters are taking within the directors and officers insurance market. This ranges from nominal increases in standard to drastic capacity shortages and punitive terms for more heavier risks. The same principles and rationale can be applied across all other insurance lines, whether that be public liability, employer's liability, professional indemnity, motor insurance, property insurance. It can all apply across all lines of business. So what can we do within Marsh Commercial to manage the market and also to manage your expectations? Personally, I would recommend that you start your renewal tenders and engagements early. We're talking anywhere from 6 months prior to renewal to 3 months prior to renewal. Whilst there's no silver bullet, by adopting good practice and engagement, we can better prepare you for the renewal process journey. There will be some bumpy rides over the next 12 to 18 months with insurers pricing correctly. Allowing sufficient timescales and driving consistent communication throughout the process is key. It's important that we consider our marketing options carefully, especially where the holding market is reducing capacity or that they are in runoff. You as insurance buyers need to be having robust discussions with your brokers about the insurers they place your business with and the capacity that they have to pay claims, and asking the question of, will that insurer be around in a few years to pay claims from an employer's liability point of view? As brokers, we have to consider whether we've got sufficient information on your risk and if the programme and the remuneration design is still appropriate. Luckily for us, Marsh, our parent company, have a range of tools available to us, including claims advocates, benchmarking tools, and risk management. These are our differentials, and they support the drafting of our quality broking presentations that present our clients' risks fairly and positively. As part of our engagement with insurers, we ensure that we keep abreast of the market appetite and perception of our clients' risks and trades. For larger and more complex risks, a tripartite relationship can help build a greater investment from insurers. So whether this is through risk management or claims engagement or insurer days, where the insurer spends time in your business getting to know your operations and your risks, there's only so much that we can tell them as a broker, where actually if an insurer comes to your premises, gets an eyes on of this is your operation and this is how well it's run, they are more likely to offer you favourable terms. Now, where we are facing pricing challenges, it's important to understand the key drivers of you from a client perspective. What I don't want to do is advocate wanton erosion of credible programs, but some examples to consider may include the reduction of a 50% day one uplift to a lower inflation-proof limit, which may help achieve 100% placement for a lower premium. Understanding the costs attaching to ancillary extensions that may be deemed superfluous. And the potential for loss limits, increased levels of self-retention and the like that you and your business are willing to take on. If you're willing to take on a higher excess, or if you're willing to take on some of the risk yourself, you are going to get better terms from insurers because they are seeing you as acceptable business. This is something that you discuss with your broker, you can discuss with Marsh Commercial, and we can guide you through that process. As we've explored, insurers' perspectives are changing. There are claims examples where the actual risks are different from what was perceived at the outset. So it's important that we work with you as clients to understand the underlying trends behind claims and how these can be managed. If we can drill down that you have a number of motor claims over a year, and they happen to be on a Friday afternoon between the hours of 3 p.m. and 5 p.m, that trend can be addressed. That can be drivers wanting to get home for the weekend, so they are rushing in those last few hours. That can be a training need which is identified. We train the drivers in that area. We incentivize them for driving well on a Friday. We install cameras into vehicles. What that does is that reduces those claims. By reducing those claims, we reduce your premiums in years to come. It's not an immediate fix. However, it's a fix for further down the line. Now, there are key pillars to consider when preparing a broking presentation. So this is what we do as brokers. This is how we get insurers to give you quotations. What's the actual risk? We can influence the risk, but we fundamentally can't change a trade which may be on an insurer exclusion list. How's the risk presented? Does it flow? Is it signposted? And is it informative? Our job as brokers, when we obtain quotations for you, is to paint a picture of a very well-run business who control their risk. What's the story? This is our opportunity as brokers to showcase your initiatives and efforts. If you've invested in risk management, we should be shouting about it. If claims trends have improved, we should evidence the intervention. And as discussed previously, if you are willing to consider different deductibles and limits, the insurers are always keen to see you retain some of the risk. My suggestion on a broking presentation is to ask your broker for a copy of their presentation that they are sending to insurers. Does it paint you in a good light? Have they told them everything? Does your broker really understand your business? Do they know what you do day in, day out, and what your main risks are? As insurers return to technical underwriting, we can expect that there will be requests for additional information. However, this can drive fair outcomes for you. Let's consider how insurers, for example, price natural catastrophe risk. A key tool will be their flood mapping model. So here, we have an example of a UK risk where the postcode is incomplete and the risk information is nominal. A sample flood model is generating a proposed annual premium of £4,500. For the same location, we've made further inquiries and are able to provide a full postcode and construction risk management features of the property too. The same flood model is now generating an annual flood premium of £100. That's £4,400 cheaper. So this is a really good example where the provision of further information can drive a fairer outcome for you. This is one of the reasons why it is important to select the broker you wish to work with, as you will need to review a lot of information about your business and activities prior to the broker being able to put together a quality broking presentation. But that concludes today's webinar. I'm John McCardle. I'm a development leader with Marsh Commercial. Many thanks for your time, and we look forward to engaging with you in due course.